Hello everyone. In the prior chapters, we focused on understanding of the different cost concepts and in manufacturing industries, how to accumulate, record, and prepare the cost reports to satisfy the needs for both external and internal users. From chapter 6, we will introduce more materials related to the planning and controlling function of managerial accounting. So that means we will focus more on the predictive analysis and the prescriptive analysis. In chapter 6, we discuss cost volume, profit relationship, and analysis. This is a very popular and important managerial accounting function. To simply put it, CVP analysis is used for managers to determine how change of the cost and the volume will affect the company's operating income and net income. The cost can be a variable cost, can be a fixed cost, can be a product cost, or period cost. Or the sales volume or production volume increase or decrease, and we will see how the operating income will respond to these changes. To understand this relationship is critical for managers to plan for the future operations. So you can plan with different scenarios and choose the best option for the company's development. For CVP analysis, the base format we use the contribution margin income statement, which we introduced briefly in chapter 1. So the contribution margin income statement require all of the company's cost, including manufacture, selling, and admin cost, are identified as variable or fixed cost. If you have mostly mixed cost, we can use the regression analysis or some other ways to separate the mixed cost into variable portion and fixed portion, so we can conduct the CVP using the contribution margin income statement. And this is the same example we talked about in chapter 1, a comparison between the traditional income statement and the contribution margin income statement. And this example is used for merchandisers. So in this case, all of the cost of goods sold for merchandisers, they bought it from vendors, so we treat them as variable cost. For manufacturer cost, some of the cost of goods sold, as we learned from prior chapters, they may include some fixed portion, and we will see the difference later in the examples of this chapter. But here, just to focus on the basic differences. The traditional income statement will focus on the difference between product cost and the period cost. And the separator is the gross margin. Before gross margin, we deduct all of the product cost. And after gross margin, you deduct all of the period cost in terms of sales, admin, or other general expenses. For contribution margin income statement, this is only available for internal managers. External users, they can access the traditional format, which is publicly available, but they cannot access to the contribution margin income statement, which contains all of our variable cost information, contribution margin, and fixed cost. These information are very sensitive and private, business information for the companies. So we don't disclose to external users. And the contribution margin is the divider between your variable cost and the fixed cost. Before contribution margin, we deduct all of the variable expenses, variable cost. And after contribution margin, we deduct all of the fixed selling and fixed element. That's for merchandisers. So even you arrive the same net income, but the process we got this number, you have different focus. And in some cases, for the manufacturer setting, when the production volume and the sales volume is not the same, the net income we calculate from the two income statement may be different. You wouldn't have the same net income if you use the two different approach. That one, if we have time, we will talk about in chapter 7. Chapter 7, we talk about variable costing, absorption costing for like we will wait that time to see. But now we are assuming all of the products will be sold to customers in the same accounting period. So this is the comparison. Contribution margin income statement not only used for CVP analysis, it is widely used for some other internal decision and controlling scenarios also, such as segmented reporting of profit. In Chapter 7, segmented reporting is your performance report for internal departments or internal functions, different divisions, different stores, or different product lines. Again, for external users, we don't disclose the segmented information. You only show a comprehensive income statement for the company-wide. Segmented data is only available for internal managers. In budgeting, when we make a comprehensive or master budgets for the future, you need to planning for all of your revenues, all of your cost expenses. So we definitely will use the contribution margin income statement, so variable expenses, fixed expenses, so we can plan and predict the future cost and expenses, and lots of the special decision such as the pricing, special pricing, or make or buy decisions, bottleneck analysis. In chapter 11, that's very so in the daily operation management for internal managers, your understanding for the contribution margin income statement is very critical, and you can see the application in your daily, like the operation of your jobs. When we do the CVP analysis, we have some key assumptions. You understand, right, like in science, right? So in like when you study math, physics, or chemistry, when we derive a formula or like the those calculations, sometimes we have assumptions, so the formula will be hold under these assumptions. When we do the CVP analysis, we are assuming some of the conditions will be met, so the formulas or the scenario or the approach can be done by the managers and analysts. The key assumptions will include, so here we are normally assuming the selling price is constant in our planning period. So we are planning for the 12 months next year. We normally fix the sales price, rather than make it fluctuate, or even when you make budgets, the selling price we normally hold it constant. So the analysis of the cost and income will be more simple to follow. So also the pricing of the product or service will not change as the volume change. You may say it's not really catching the real world operations, right? So when the volume change, we most of the time will adjust the price. You can do it, when you do the actual operations, but when you planning, making some like straightforward plannings, we mostly hold the sales price constant, because the sales price we can easily to change and see how the change will affect the other factors in the analysis. And the second is also like more critical. We are assuming all of the costs and are linear and can be accurately divided into variable and fixed components. From our learning in chapter 1 and the prior chapters, we know this is not really true in the real world because most of the costs are mixed. They may have curvilinear relationship, not like a straight line going up or going down or stay constant. But to perform the analysis to planning for the future, we need to enforce this variable and fixed cost separation. So even like using the most accurate approach. And variable costs are constant per unit. Okay, that's also like so the variable product cost, variable period cost are fixed. And so this must be careful. Okay, constant, not really fixed. So like for per bicycle, we have $150, all of the variable costs per bicycle, right? So that's a constant. And the fixed costs are constant. The total fixed costs are constant in the relevant range. So when we make this prediction analysis, we are limiting our data use and data application in the most relevant range because if you go above or go beyond, go below the range, the cost behavior will change. And in multiple products companies, which is actually the real world case, every company make more than one, right? More than one type of products, or they operate more than one department or divisions. And when we do the CVP, we are assuming the mix of the products remain constant. Means I have a already have a portion like how much percentage of different products in the total product mix. If you change the product mix, that may affect your cost structure or selling the sales price strategy, so make the situation too complicated. So when we do planning, there are some situations we want to simplify so we can perform the analysis. But in the real world, you always can adjust these situations according to your real operations. And here is a review and also kind of like compare with the manufacturer industry, compare with the merchandise industry, the manufacturer company, what are their variable cost examples and what are their fixed cost examples. So as a review before we proceed to the examples used in this chapter. So variable expenses in a manufacturer setting typically include your direct material for different products. You may have hundreds or thousands of parts as your direct material. Then you have the direct factory labor work on the products. Then we will have the manufacturer overhead as variable and fixed. You have the manufacturer overhead separate into variable and fixed portion. Then all of your period costs, selling, general, and admin expenses, you have variable and fixed portion also. So by making clear what are the categories or components for these two cost category when we perform the analysis, and we normally use the total variable cost and total fixed cost, but you can relate what are the detailed components for each. And here we also can see again the graphing or the charts for the variable cost behavior and the fixed cost behavior. For variable cost, the total cost is a linear, right? So we assume is a linear regression, linear line. as we increase or decrease the production or sales volume, your total variable cost will increase or decrease proportionally is a constant variable cost per unit. But fixed cost in the relevant range will stay as a constant. Even the per unit variable cost. Okay, if I can draw this. So fixed cost per unit is a decreasing curve. So per unit fixed cost and per unit variable cost is a constant. So be careful when you talk about this cost behavior. You must specify you are talking about the total. This is total and this is per unit. And for fixed cost, the constant is total. The total is constant, and the unit fixed cost is decreasing. Okay, that's a full understanding for the cost behavior. Now, after get this review for the contribution margin income statement, fixed cost and the variable cost behavior, now let's see additional how we can use the contribution margin income statement to apply to the CVP analysis. So explain how change in the sales volume will affect the contribution margin and the net operating income. And in our example, let's see.